Hey, what's up everyone? My name is Lawrence and welcome to my channel, where I teach you how to become a day trader through tips, resources, and best of all, insight on my journey to becoming a profitable day trader. In this video, I'll talk about what you need to do to become part of the top 10% of day traders. Trading is one of the hardest skills you can learn, but once you got it, it's almost like making money out of thin air. I'm going to be talking about the three main focuses that make a successful trader and how they're all connected. Okay, so the three things that the top 10% of traders focus on are their trading plan, trading psychology, and risk management. So trading is a risky business because you never know what's going to happen for sure. It's like life. You can't control the world or anyone else, but you can control yourself, and that's more than enough to become successful. So having a well thought out trading plan will give you more confidence to trade because whatever the market does, you'll have an answer for it. Without a trading plan, you'll deal with uncalculated risk that gives you even more uncertainty than there already is. And that uncertainty will create nervousness, fear, doubt, and that will affect your performance. Poor performance equals a lot of money lost. Also, a trading plan gives you an edge. So when you write a trading plan, there may be a specific pattern you're looking for on the stock chart. There may be a signal that you're waiting for, whatever the case may be. Always have a trading plan so you can have an edge. And when you have an edge, it increases your chances of winning your trade. With no edge, that just means you're gambling. It's like going to the casino, hitting the roulette table and putting it all on 25. You don't know, like it's just a random guess. You're gambling. So we don't want to do that when we're trading because 9 times out of 10, 25 is not going to hit. Honestly, it's probably 9.9 chances out of 10 that 25 is not going to hit. So a trading plan gives you an advantage. You can't control the market, so the only way to win is with an advantage, right? Now, moving on to trading psychology. Trading psychology is 90% of the battle. You can learn all the patterns and trading strategies in the world, but if you don't have the right mindset and emotional intelligence to follow through, you won't do well. And that's in any business or profession, not just trading. You can watch any interview by any professional across any field. Their mental fortitude is unmatched. Fear, uncertainty, and doubt and greed will mess you up, mess up your execution, no matter how good your plan is. And this is why 90% of day traders fail. So fear, uncertainty, and doubt, we normally shorthand it and call it FUD, right? So there's a lot of things that FUD can do to mess up your trading. So like I said, with the trading plan, there may be an edge that you're waiting for. But one of the things that FUD does, it can, scare you from taking your trades. Like if you're fearful, if you're uncertain and you're doubtful with money on the line, your hard-earned money, you may not take a trade. Your setup might be looking at you dead in the face. All probability, all odds are in your favor, but you just will not take that trade because you're nervous, you're scared, right? Another thing that FUD can do is it can cause you to enter your trades too early or too late, like enter and exit your trades too early or too late, which can really mess up your trading plan, mess up your profits and all of that. And lastly, lack of confidence. This is major. So no matter what you do, if you're an athlete, if you're a musician, any type of performance based action skills or whatever, you have to have confidence. I think that's pretty self-explanatory. Another thing with trading psychology is greed. Now, when you're getting greedy, there's a lot of things that can happen here. It can enable over trading. When you trade too much and say, for example, if you win your first trade and now you're feeling greedy, you want more, or you're overconfident. Now you're going to put on another trade and you end up losing that trade. So now you then took away from your profits, and that $100 that you initially won, now you only have $50. And you're just going to wish that you never took that trade. Another thing is delayed exits, right? So that's one thing that FUD and greed have in common, delayed exits. When you're in profit and you know that you should probably take profits, but you want more money, thinking that the market can hear you or something like that, and you don't get out when you're supposed to. And then the price goes against you and you end up losing a lot of money. You can turn a winning trade into a losing trade very quickly. No discipline. Discipline is I would put discipline as number one, because if you're disciplined to your trading plan, FUD and greed will have no effect. And even if it's present, you can still overcome it with discipline. So discipline is really number one to me. With no discipline, your entries and exits are premature or delayed. Anything that is not according to your trading plan, that's considered no discipline. And over time, you will lose a lot of money. If it's not this trade, it may be the next trade. You got to stick to your trading plan. Biases, not predicting, but observing, right? So you want to observe what the market is showing you. You may look at the stock charts and think it's going to go up, go down. It's subjective. The stock market is irrational. It doesn't make sense. It's incomprehensible, if that's a word. You can't make sense of it, right? So you have to react to what the market is giving to you. You have to be like water, and you have to shape yourself into whatever shape the market is formed in. You have to follow the market, and you don't predict, you observe, and then you apply your trading plan to what you observe that the market is giving you. Lastly, there's ego, feeling like you can't lose. There can be, you can have a series of wins. You can have 15 winning days back to back to back, and you feel like you're the man. But guess what? Eventually the market will humble you, right? So don't take each trade and place value on it as how good of a trader you are. Just at all costs, stay level-headed, keep 10 toes to the ground. Don't get too high, don't get too low, right? So 90% of day traders fail because of poor trading psychology. 10% of traders succeed because they constantly work on it. To improve your trading psychology, you must have a good and detailed trading plan, discipline, faith in your trading plan, and confidence in yourself to execute it well. Now, moving on to risk management. I thought trading was a zero-sum game, meaning either you win or lose, until I read this book, and they said that trading is a minus-sum game. Because if you lose $100, you lost $100. But if you gain $100, you really gained 95 because of negative slippage, commissions, and fees from the broker. And all of those make it a minus-sum game, right? So this brings me to risk management. Trading is meant for us, the retail traders, to lose, which is why risk management is very important. It keeps us alive, right? So the biggest thing with risk management is position sizing. Don't risk more than 4% of your account per trade. And actually, 4% is considered very aggressive. A lot of people say 1% to 2%. But, I know how we all are. So I'm just going to say 4% just to be honest, right? Never add to a losing trade. So if the trade, here's a tip. Whenever you enter a trade, most times the trade will go in your favor. If you're reacting to the market as you should and not predicting or being proactive, if you react to the market and it shows you the trend or the direction that it's going in, the trade should be in your favor immediately. So if you're experiencing hesitation or the price is going against you more and more, do not add to it thinking that it's going to turn around. Get out of it. The trade should go in your favor immediately, almost all the time. Avoiding slippage. Trade high liquid with tight spread stocks. I'm going to get into this for another video as far as like the bid-ask spread and the negotiation of buying and selling a stock and how there's slippage in between it that can be negative or positive. But I think that that's a discussion for another day. Then you have reward to risk ratio. Only take trades with at least a 2-to-1 reward to risk ratio. Meaning, if you put on a trade, make that risk worth it, right? So I'm not going to put on a trade and risk my money to risk $1 in order to make $1. That's 1-to-1. No, if I'm going to put on a trade, if I'm going to take on some type of risk, I want to risk $1 to make $2 or $1 to make $3 or more, right? So make it worthwhile. Even if you lose, you can look at it and be like, well, shoot, I would have took that trade all day, right? That was worth it. It'll make you feel better about that loss. Trading is a minus-sum game where the goal is to stay alive. When the losing streaks come, because they will come, right? It may not be your fault. Your trading plan may be executed perfectly. Maybe the market may be acting irrational for a little while. So when those losing streaks come, risk management will keep you alive. And that is the name of the game. I like to look at trading as a video game. I want to stay alive. And the moment my account goes to zero or I blow up an account, I lost the game. I had to put more money in it and pay to play, something like an arcade, right? But anyway, trading is a get rich slow game. So don't be over here trying to make like home runs, risking 50% of your account on one trade, all that good stuff. It's a get rich slow game. Slow compounds will add up quicker than you think. Trading with big size will ruin your trading psychology, thus slowing your account growth or even blowing it up. And this is very important because with bad trading psychology, you will become a part of the 90% of day traders who fail. If your account is at $1,000 and you're risking $900 on one trade, and that price goes up against you 10 cents, like a normal retracement that was healthy, because you have so much money on the line, you may think that you're about to lose the whole $900 and exit prematurely, and take a loss. Next thing you know, the trade goes into your favor and you're looking at it and just disappointed in yourself. So use a good amount of size. Use 4% or less, 1 to 4%, and it'll give you clarity when you're managing your trade, because trade management is just as important. Okay, so here are the day trader laws for this video, which are key points and good things to remember when trading. We're going to be showing how the three main focuses, trading plan, trading psychology, and risk management, all connect with each other, how they all intertwine, right? So a solid trading plan gives us certainty and answers ahead of time. If A happens, I will do B. If C happens, I will do E, because, I don't do the D. But anyway, with certainty, we'll be more confident to take a trade. Confidence improves our trading psychology. Our plan must include entry and exit signals, risk management, a trading strategy, time frames, indicators, etc. Moving on to the trading psychology. With the confidence a trading plan gives us, our trading psychology will be in better shape. Practice emotional intelligence while in a trade. During a trade, we're all human. First and foremost, when I say that we're all human, we can't cut off our emotions, so we have to acknowledge them, right? And we have to understand why we feel this way. So during a trade, acknowledge what emotions you're feeling and why. Is it fear? Is it uncertainty? Is it doubt? Is it greed? And why are you anxious, right? And once you figure out which emotion you're feeling, review your trading plan for reassurance to calm those emotions down. Because a lot of times, the reason why we have these emotions is because we're uncertain and we're risking something that we care about. So in this case, we're uncertain about which direction the stock price will go in, resulting in our win or loss, and we're risking our hard-earned money, right? So once we find an answer, it gives us more certainty, it clears our mind, and we become more confident. So review your plan for reassurance to calm down your emotions. Like I said, most emotions come from uncertainties. And one big thing is accept that you might lose before you trade. There's a likely chance that you'll lose. You'll have to accept that. The moment you accept that, the easier it will be for you to take that loss if you lose. Trading psychology dictates your trading career. That is not exaggeration. Your trading psychology dictates your trading career. When you continue to work on your emotional intelligence, when you continue to believe in think in probabilities, meaning as long as you have a great trading plan and you continue to follow your trading plan in the most disciplined way, you will win over time. Lastly, you have the risk management. So risk management is found in your trading plan, and proper risk will help improve your trading psychology. No trading plan or edge is 100% guaranteed. So we have to use risk management. Less risk, the better your trade management will be. So like I said earlier, if your trading account is at 1,000 and you're trading with $900 out of your 1,000, you're going to be so nervous to lose that $900. The amount of stress that you're going to feel is not worth whatever money you're going to win. I promise you. And then when you do win that money, you might fall victim to becoming a little bit, egocentric. Like you're just going to feel like you're the greatest thing alive, but it's just not the case. So it's kind of like a lose-lose. Now, when you risk less, like out of that 1,000 and you're risking $50, Your mind is clear. Like, it's just $50. If I win, that'll be great. It'll add on to my trading account, slow compounds. And if I lose some of my $50, that's fine. I live to fight another day. More risk will empower impulsiveness and ruin your discipline. So when you're risking more money, you become more impulsive. Like I said, if the stock goes back for a healthy retracement so it can continue to go in your favor in the middle of your trade, you might see that retracement as a full reversal. And you might become impulsive and get out that trade and take a small loss when it was just a healthy retracement to continue to add to your gains, your profits. It'll also ruin your discipline. When you have a lot of money on the line, you are less likely to follow your trading plan. Big losses will make you doubt your trading plan and ruin your confidence. This is the expense of using too much risk. When you lose big, man, it's the worst feeling in the world. I'm going to tell you that right now. It's the worst feeling in the world. You're going to think that, you suck at trading. You're going to blame your trading plan. But just know this. Another tip is all trades lost is your fault. Own up to it. Your trading plan is fine. Don't let it affect your confidence. Don't get attached to wins and losses. Don't put too much value on that. It does not define you. It doesn't have any type of effect on your self-worth. Okay. Big wins will fuel your ego, leaving you exposed and lenient on your rules. So a lot of times when we win big, we feel like we're the best trader alive. We want to add more risk. We can't be wrong. So let me go ahead and put more money on it. And that's where the market gets you. I've been a victim of that. I've done it. That's where the market gets you. Do not get too high on your wins. Don't get too low on your losses. Because a lot of times, in my experience, following a big win comes a heavy loss or comes a loss in general, right? So continue to have proper risk management even after your wins. Stay humble, stay grounded. Big wins, small wins, break even, or small losses. Those are the only 4 options that you have. You can do 4. And the 5th option is big losses, but that's not even something that we want to do. You can do 4 out of 5 of those things. You want either a big win, a small win, break even, or a small loss. That's all you have to do over a period of time. And trading technically will grant you financial freedom over a series of years. Now, one thing that is very, very important that I had to add in here is you are the weakest part of your trading plan. Strengthen your trading psychology to become a part of the 10%. Like I said earlier, every loss that you take while you trade is your fault. And a lot of us have a lot of problems with accountability. But the thing is, it's okay to lose. A loss, I know this sounds so, cliche, but a loss is only a loss if you don't learn from it. So, hop on the Zoom app, record yourself trading, record your trade, screen record, get a journal, write down what you did wrong, write down what you did right, and write down how you'll improve this and critique your trading plan so it can fit the market. Okay, so understand that you are the weakest part of your trading plan. Strengthen your trading psychology, and you will become a part of the 10%. So I hope you guys enjoyed this video. And if you did, don't forget to hit that like button and subscribe to my channel. Hit the bell to be notified when I drop new videos, and y'all be easy.